Hi, this is John Sloan with Keller Williams Luxury Homes. As part of our educational series, it is my pleasure to introduce you to Scott Varney, who's a capital gains strategist, and Angel Vera, a structured settlement consultant. These professionals will help you understand how to avoid taking the entire capital gains tax hit in 1 year when selling a primary home, investment property, or a business. Enjoy the video. Here's Scott.
All right, good morning, good afternoon, depending on where you're at in the country. And for those of you in Hawaii, I hope you have a big cup of coffee because I know it's early. Thank you for joining. My name is Scott Varney. I am a capital gains and income tax strategist. What does that mean? That means that I work with clients to find a strategy that best fits their needs and their goals. And many times there are strategies out there that they are not aware of, mostly because while they're CPAs may be really good people. Most of them are plug and play compliance officers. They're not tax planners. And so when people call me, they're like, my CPA hasn't told me that. And it's like, well, that's not their job. So what they do is they put in the numbers in the right place and make sure it's filed correctly. So CPAs that are tax planners will charge you $2,500 per quarter or $2,500 per month or more to do tax planning. But everybody wants a tax planner at tax preparer prices. So that's where I come in as I help to find the strategies that would possibly fit the client and then we can work with their CPAs. And and so that being said, today, one of my partners in the industry, Angel Viera, is going to do a presentation on structured installment sales. And that is one of the strategies that I really, really like. And he's going to walk that through. And so, with that being said, I'll let Angel talk about his background. And so, wherever he is on your screen, go ahead, Angel.
I appreciate it. Thank you, Scott, very much. Hi, everyone. Good morning or good afternoon. My name's Angel Viera. I'm a structured settlement consultant. I've been in my industry close to 30 years. My office is here in Los Angeles. We provide services in California, nationwide, and in Puerto Rico. As a structured settlement consultant, most of what I've spent my time doing is helping clients settle various types of claims, typically personal injury and wrongful death claims. And we use a very unique annuity to settle these claims on a tax-free growth basis. And the reason I mention that is because I operate in a very unique broker industry. So in addition to tax-free for physical injury claims, the industry eventually evolved to tax deferral on employment litigation, divorce, and things of those types. So we're able to annuitize these payments into the future for the taxable cases where the taxes are payable or due in the future. So within my unique broker channel, there's only 10 annuity companies that operate in this channel, and two of them have expanded their services to include the structured installment sale, and that's what we're going to go through today. Bear with me. So what is the structured installment sale? So it's for the sale of a property or business that qualifies under Internal Revenue Code Section 453. That's the installment sale section. What makes this product interesting and unique, it's that it's good for a primary residence, rental or investment property, commercial property. It could be vacant land or for the sale of a business. And what we do is if one of these entities is sold, we can take part of those sales proceeds and convert them into a guaranteed income stream into the future. That allows the seller to defer the payments, spread the payments out, reduce that taxable income into the future, and hopefully get the sellers into a lower tax bracket. So not only are they paying less tax, but that deferral mechanism, they're paying the taxes in the years in which they're receiving these payments. So the seller and the buyer must qualify to sign these documents, and we can get into a little bit more detail about that in a second. And again, these two, the structured installment sale is currently offered by American General and MetLife. American General's been a life insurance company for 100 years. 25 of those years, it's been in the structured settlement industry. And when it comes to MetLife, MetLife's been around for 158 years, of which 40 years it's spent in this unique structured settlement industry. And because you're dealing with life insurance companies, these are financially strong, highly regulated life insurance companies. Because you've got two different annuity companies, there's varying underwriting and tax reporting requirements for each. So what we typically do when I'm lucky enough to talk to somebody like Scott, this product is not here to compete with any other tax deferral product. It's just to be able to offer the seller another option. And what I like about Scott, Scott kind of runs the whole show. He sees the big picture, and we've had these conversations, and in some cases the structured installment sale is a great fit, and in some cases it just doesn't make any sense. And that's what I like about dealing with Scott. And I think Scott recognizes it's just another option. So again, the buyer seller enter into a sales transaction. The sales proceeds would go into escrow. So the way the structured installment sale works is we have escrow fund the future periodic payments directly. So there's no constructive receipt on behalf of the seller. With American General entering this area earlier this year, we have some additional flexibility. So those first payments can be immediate. They can start within 45 to 60 days after the annuity's been funded. Or with the likes of an American General, you can defer those payments out into the future, for years before that first annuity payment is payable. The duration of payments are typically anywhere from maybe 3 years at a minimum, and we can make those annuity payments go out as far as 40 years or even longer in some cases. Those payments can be either monthly, quarterly, semi-annual, or annual. And in the case of American General, we can do a combination. You can have a guaranteed monthly income of X, and then we can do periodic lump sum payments at certain points into the future to trigger. Maybe it's property taxes, maybe it's whatever it is the seller wants to set up, right? So we can help them tailor these future payments to what their wants and their needs are. These payments, once they're set up, they're fixed. So these are fixed guaranteed payments. Once they're locked in, they don't change. Changes in the financial markets have no bearing on it. These annuity companies or these insurance companies, they're going to have a contractual obligation to make those payments. There's a competitive rate of return. Today, that rate could be anywhere from maybe 3% to 5.5%, maybe even 6% rate of return, depending on the duration of those payments and depending on when we lock these annuities or structure payments in. The other thing is, and I get this question a lot, but there's no management fees, right? So because these payments are guaranteed, you're not going to be charged a management fee from one of these insurance companies. Each annuity payment or each payment in the future will consist of the return of bases, which would be tax-free. There's going to be a capital gains component, so you're going to pay capital gains on that. And then there's the interest component, which is typically taxed at ordinary income. And it goes without saying, I'm not a tax person. We don't provide legal or tax advice, but more than happy to jump on a call with buyer, seller, tax person, legal person, answer any questions they may have, because we want to make sure that the buyer, seller are comfortable with the transaction and we address all of their concerns, if any. So when we're looking at the sale, typically, or what I see often is some of the questions we get on selling a property. There seems to be kind of a sweet spot when it comes to real estate. And it's, folks between the ages maybe of 70 to 85. And what I find is these are folks that are looking to downsize from their primary residence in many cases or sell an investment property. And, a lot of these folks don't have what I believe to be proper representation. When I ask hey, who's your tax person? Angel, I'm 80. My tax person either passed away or they retired years ago. I haven't talked to anyone. Okay, let's slow down a bit, because you really do need to go talk to a tax person, because a lot of times these folks aren't aware of these typical types of taxes they may have to pay. So on here, I've got listed the federal capital gains, the net investment tax that a lot of people seem to not be aware of, and of course the state capital gains tax. Another big surprise during my quoting process, somebody will mention depreciation. Maybe it's on a rental property or something, and the seller will say, Angel, don't worry about it. I've depreciated it fully. I'm like, no, you might have to pay depreciation recapture tax. That's an additional tax. So again, we're trying to do right by these folks and make sure they're making an informed decision. But when you're looking at these tax brackets, the goal is that if you take some of those sales proceeds and spread it out over time, you can place the seller into a lower tax bracket, minimizing some of the taxes here. I remember a couple years ago, Scott and I did one in Florida, and it was a senior selling a rental condominium. And because Florida doesn't have a capital gains tax, we were able to annuitize the balance of those sales proceeds and get them into a zero capital gains tax bracket. It doesn't happen all the time, but every case is going to be different. The quotes are free. There's no commitment for me to run this quote. I can run one quote or 20 quotes. It's not going to cost anyone anything. Again, we just want to make sure these folks are making an informed decision. So let's talk a little bit about how these guaranteed payments actually work. I will start by saying that with American General coming into this space, the minimum premium that is acceptable is $100,000. Currently with MetLife, the minimum premium is $500,000, right? So somebody like Scott will call and say, hey, Angel, I've got a scenario. Well, let's run through the scenario and let's figure out what's the best option for the seller, based on whatever it is they're trying to accomplish. In this scenario, I'm using $1 million premium, but again, be aware that the minimum premium would be $100,000. But what I want to show you is how these payments actually work. So I have a number of payments here, anywhere from 5 years to 25 years of payments. These payments that I have listed here would start immediately, about 60 days after funding. So if you took $1 million premium and I gave it to either American General or MetLife, these are sample payments, right? So giving them $1 million, if the seller says, look, I only want these payments payable over the next 5 years, it would generate a monthly income of roughly $18,390 a month. And now let's say we've locked that in. Well, because there's an interest component, the $1 million has now generated a guaranteed payout of $1.1 million. So not only is that a pretty good deal, but I think even more importantly, we've lowered on the right-hand side column, you'll see that taxable income down from $1 million lump sum down to $220,000 in this income, right? So based on the needs of whatever the seller's looking for. Now, if the seller comes back and says, I want that third bullet point there, Angel, so I want payments for 10 years. Okay, well, it'll generate a payment of about $10,000 a month for the next 10 years. Payments are fixed, guaranteed, no management fees. So if you put in $1 million, you've got a guaranteed payout of $1.2 million, but you've also lowered your income, down to $123,000. The inverse is correct also. I may have a seller that comes back and says, Angel, what would it cost? How much would it cost me to generate, $8,000 a month for the next 7 years and 6 months starting on this date? And I can back into exactly whatever that premium cost would be. So again, there's flexibility on the front end to tailor make these payments any way the seller is looking to get them done. What I don't have here is, again, because American General came in recently, is these folks can also defer these payments. So now let's say Somebody comes in with $1 million or $100,000 and say, look, I want to put this money in, but I want that first payment payable. Maybe pay me a lump sum 5 years out. Fantastic. So what's happening is in the interim, this thing is building interest, right? So if you put in $100,000 and the lump sum pays out 5 years or 10 years out, it's going to be that 100,000 plus whatever that additional interest component has generated. So the payments can only go up. These payments are not subject to reduction. They're going to be exactly the way they're spelled out here. So now bear with me here a little bit. So when we're talking about buying and selling, I thought this would be a pretty good example. I've got two samples here. One is what's the advantage to the seller? So now I've got a seller selling a property, whatever it is, and they're asking for $1.3 million. Okay, so what can we do with 1.3? Money goes into escrow. The seller determines how much cash they want up front. That's totally their call. And in this scenario, the seller says, give me $300,000 in cash, annuitize the $1 million over the next 10 years. So the total disbursement is $1.3 million. But if you look at the numbers on the right-hand column, the total payout between the cash up front and what the annuity or the structured installment payments are going to generate, the total there is $1.5 million, right? So that's a pretty good option, I think. And then when you scroll down and you look at the buyer advantage, this is still actually a buyer-seller advantage, because we've had the question, can the buyer take advantage of this? Well, absolutely. If you've got a seller asking 1.3 million and the buyer comes to the seller and says, hey, I'll offer you $1.2 million via the structured installment sale, but let's take a look at what this thing can generate. So in this scenario, maybe the cash up front would be $200,000, right? Because it's going to be for less, a number less than the 1.3. We're still going to annuitize the same amount. I just kept that same number in there to keep it simple. So now there's a total sale of 1.2 million, but if you slide over to the right, the guaranteed payout is $1.4 million plus. That's still larger than the original asking price, and the payments are making it such that there's better tax efficiency, right? So not only is the seller getting more dollars over time, it's being done in a tax efficient manner. So, that's just one other scenario. So it's kind of like a sliding scale. What is the buyer seller trying to accomplish? Let us run some numbers to generate a scenario that they think would benefit them. I've had the question before, and I'm just going to make a quick note about it here. Some people are under the impression that, well, if I take the $300,000 and I've got the tax exclusion, I can take $300,000 in cash, 100% tax free. That's typically not correct. From my understanding, again, not being a tax person, there's going to be a percentage in there that's going to still be subject to capital gains. So those are the things that need to be discussed with someone's tax or legal person, because they can set them straight on that. What makes this product unique compared to other tax deferral products? Can be used on a primary residence, right? And so again, the low-hanging fruit, in my opinion, might be primary residence, folks looking to downsize, move across the country to be closer to their grandkids, folks looking to move into an assisted living type facility, right? So now you've got these guaranteed payments that can help offset some of those payments. We might be able to do a possible hybrid on a 1031 where someone has some boot. We might be able to annuitize that boot on a tax deferred basis. The payments are issued by highly rated, regulated life insurance companies. The payments are tailored to the seller. The seller tells us what they want in cash and what those future payments should look like. We tailor make those payments and we lock those payments in so the seller knows exactly to the day, to the dollar, exactly what these benefit payments are going to be. Again, the payments are not subject to change. They're not affected by fluctuations in the market. You get a competitive rate of return. There's no management fees from the insurance carriers. There is an option to add a cost of living adjustment. Each annuity company will have its own minimums and maximums. And so what happens with these payments and all these payments are guaranteed. There are no lifetime payments under the structured installment sale. They're only for a fixed number of years. So what happens if the seller or sellers die prematurely? Any remaining payments are still guaranteed to be paid, so they're payable to the beneficiary. And so the options that are chosen at the very beginning are that, hey, if I or we, the sellers, die prematurely, continue to make those guaranteed payments, just redirect them to this beneficiary. They'll also have the option at the onset when they set this up to say, if we die prematurely, any remaining payment should be commuted to a present value and paid out in a lump sum. Or the third option is they can say, you know what, if we die prematurely, if there's any remaining guaranteed payments, commute 50% or 80% or 30% of that, pay it out in a lump sum, but continue making these guaranteed other payments, as stated. The limitations with this product, changes are not allowed. There's no liquidity. You can't borrow against it. You can't assign it to anyone else. So part of our due diligence is kind of to make sure these sellers, especially seniors, have some sort of a slush fund, because if something happens, I mean, like for example, if they did the 5-year guaranteed payments, they've got decent income to deal with maybe some issues that come up, maybe health issues. But they're not going to be able to tap into this. So we want to make sure it's kind of a diversified kind of sale. So they've got some cash lump sum here in the event of an emergency, but they're going to have this other guaranteed income on this other end. So again, there's no liquidity with this product. What about the timing in the documents? So the timing, if somebody's looking to sell next week, next month, or next year, I can run the quotes now, right? We'll just run the quotes. Maybe the seller wants an idea as to, hey, if I were to do this, what might this look like? Maybe they want a couple months to think it over. So you can get us involved as soon as possible, but definitely before the final sale, and more importantly, before the funds are dispersed. The documents that need to be signed, there's a buyer-seller questionnaire. This is to qualify. This is a questionnaire that needs to be completed so we can send it to the life insurance company so they can qualify the transaction and accept it. And also that's very important. They need to identify the source of funds to buy the property. So, insurance companies today, they're pretty conservative. So they've got to do their due diligence. They just want to know, they want to verify where that money's coming from. Copy of the purchase agreement. They want to see that as well because they want to confirm there's an actual sale of a property or one that qualifies under Section 453. Then what we do is we prepare an addendum to the purchase agreement, which would list these future periodic payments. There's a buyer-seller statement. And most of these documents, they're 1 or 2 pages. They don't go on forever, right? So they're simple documents. They're short documents. The buyer-seller statement is just acknowledging that they're relying on their own legal or tax advice when they enter into this transaction. There's the assignment agreement. Remember, this is still an installment sale technically under Section 453. So those future periodic payments are being created technically by the buyer, but they're being assigned over to the life insurance company, and the life insurance company is taking on that responsibility to make those payments. And then there's the application. My office completes that. It'll add all the seller information. It'll complete the beneficiary information, and all of that. I'm going to open it to questions in a second, but these are the typical questions I've seen. How soon should my office be involved? As soon as possible. How long does this process take? If you are looking to sell and the buyer and seller agree to a transaction, my quote will be ready in 24 to 48 hours. My documents will be ready in 48 to 72 hours. It'll take me 2 to 3 days to complete my portion. The documents go out to be executed. So then it's a matter of how long it takes all the other folks to do their paperwork. What is the minimum annuity premium or life insurance or structured installment premium? It's going to be $100,000. Are there any age requirements? For one annuity company, the seller has to be under the age of 85. For the other insurance company, it's irrelevant, but the annuity or the structure payments have to end by age 110. So we've got some flexibility there as well. Can the seller payee be a trust, typically a living trust? The answer is yes, but we need to know what kind of trust it is because once we submit all the information to the life insurance company, they need to know all the parameters, all the moving parts to see what it is before they'll go ahead and accept it. Can monies be withdrawn from the annuity in case of an emergency? They cannot. Can I lose money? Basically, no. There's no downside to these annuity payments. They only go in one direction, and that's up. There's no chance of losing any principal. And the payments that are guaranteed to be made, like in those sample payment streams I showed you, the life insurance company is going to issue an annuity contract, a life insurance contract at the end of this transaction that's going to go to the seller. And so there's now a contractual obligation from American General or MetLife that these payments have to be made in that amount on those specific days as stated in the contract payable to the seller. What if the seller dies before all payments have been made? Again, the remaining payments continue to be made to the beneficiary, same amount or commuted or a combination of the two. Are there any tax reporting requirements? One life insurance company says yes, W-9, W-4, and then they'll issue a 1099 at the end of the year. The other insurance company says we don't do any reporting. It's going to be self-reporting by the seller. And so I think I've addressed most of the issues related to this product. Scott, do you have any questions based on any of that? And we'll open it up to any other questions.
Yeah, there's some questions that have come in, so I'm going to take a step back and just kind of do a recap here. As Angel talked about, this is following tax code 453. That's the same tax code that we're familiar with when people do say, I'm doing an owner carry. So it's an installment sale tax code. Buyer comes to the table. They bring their cash. They have their own loan. This does not at all work with the buyer in terms of lending. So they are
Thank you,
going to come
Scott.
to the
Yes.
table and close on this transaction. The seller has to have already gotten the contract in place for the structured installment sale in advance of the close. This is not something you do after the close because what you're trying to do is avoid constructive receipt. All these things are things that Angel's already touched on. So the buyer comes, they purchase the property, funds now go to a holding company that purchases the annuity under the direction of the seller. Seller says, I want it 3 years, 5 years, 10 years. So now, as Angel showed, by spreading it out, you're only going to be paying the capital gains on what you receive in that year. You're going to pay ordinary income taxes on the interest, but if it's an investment property, talk to your tax professional, you could be subject to paying the depreciation recapture taxes. And as Angel talked about, our client in Florida, we spread it out enough. We work with their tax professional. We got them into the 0% tax bracket. Most people will end up going from 20 to 15. On rare occasion, rare occasion in Silicon Valley, because you can't even buy a porta potty for $500,000 there, um, uh, where you get to the 0% bracket. But depending where you're at in the country, Angel and I could work with your tax professional and get you there. And that is a huge advantage. So now you got the payments. So this could be a wonderful thing. So buyer comes, they get their lending, they pay all cash. At the closing, let's say there's $1 million sale, but there's a $300 debt service. So this is not going to work for the debt service portion of that, correct?
That's correct.
It's only going to work with the cash. So somebody, if they have debt service, they ought to if it's going to pay out 300, they might need to withhold 100,000 of cash boot to be able to take care of the proportionate amount of taxes that are going to be owed, and then do the structured installment sale on the 600,000.
Mhm.
Right?
Correct. Correct. And again, that's where their tax person comes in. And we provide their tax and legal people with all the information they need. On occasion, if we've got to get the annuity company on the line and have a conference call, we do that as well. They're very supportive of trying to make these things productive.
And then I love that you touched on the prorated nature of this. In tax code 1031, you can pull your 500,000 exclusion for a married couple. If it's a rental property and you live there for 2 years of the last 5 years, you can pull that 500,000 cash out and exchange the rest. But with tax code 453, whatever you pull, it's prorated. So if it's 20 years that you're going to get paid, you're going to spread out that 121 exclusion over 20 years. So, it's very different. So you can't just cash out your exclusion and then do an installment on the rest. So I love that you brought that up. So I'm just kind of do a recap on a few things that you brought up in case anybody joined a little bit later. Um, can you assign, and you've already touched on this, but one question came in, can you assign the payments to another party or charity?
And cannot. You cannot, but maybe the question is, can I list them as a beneficiary? And Scott, you and I talked a little bit about using this product for these nonprofits, right? For their the terms escaping me, those other annuities that are used on behalf of
Oh, charitable gift
a charity
annuities?
gift annuity. And
Yes.
there's something there. But again, so if I may expand on that, because sometimes I'll get the question, can I reassign the payee to be someone else? You cannot, right? The payments can only go to the seller to qualify under this section and to make sure we're following all the life insurance company protocols. I'd be curious to ask, and I think the answer may be yes. Yeah, but if I die prematurely, can I list a nonprofit as the beneficiary? And we'd have to look at the specific, points on that particular scenario, kind of work them out, send them over to the life insurance companies and see what they say.
Well, and if your payments are going to be high enough to warrant a discussion, feel free to set up time with me and we could talk about trying to mitigate the cap gains on each year's worth of payments as well. So there may be something out there, especially if you've got 200,000 in gains each year, or more. So, I'm not seeing any other. Let me check the Q&A box. No, not seeing any more questions. And partly because, Angel, you covered a lot of that. One, there was somebody here that's on a lot of my webinars, and he kept typing questions, and then he goes, "Oh, he answered it. Oh, he answered it. He answered it."
Very good. I do see some questions now that I'm looking in the webinar chat. Let me see if I can you assign the payments? No.
Yeah,
Is
you've
is
answered.
it as a regular installment sale? This is under section 453. So really technically it's an installment sale and the buyer is assigning those future periodic payments to the life insurance company. So technically it's an installment sale, and these products that have already been filed with all 50 states and Puerto Rico qualify to use this product. Does a 3.8 net investment tax come into play? Probably, but you're going to have to talk to your tax person about that, right? Because everyone's situation is different, and I don't know what the triggers are going to be for that individual seller. Because on the annuity side, all I see is the annuity piece, right? Maybe the cash up front. I have no idea what other investments are back there, whatever deductions they may be eligible for, all these other things. So on occasion, a tax person will call us and say, Angel, my seller agreed to these payments, but I actually need you to tweak them. Instead of, 10,000 for 10 years, I need you to generate $8,250 for 6.5 years. Oh, okay. Well, we'll do that. How's the receipt of 300,000 handled? Again, it would be a split percentage. And part of that, I would assume, I think Scott addressed that, prorated capital gains. I'm sorry, I read the question, then I see you answered it. You answer it.
That's what I'm saying.
Ignore
Yeah,
all my questions except the first one. Okay.
Yeah.
Okay. So when you're looking at just the annuity piece, pretty straightforward. Here are the payments. You know, this is what you're going to get into the future. So yeah, it's a pretty good product, but what I like about what Scott provides, again, everyone's situation is different. But Scott understands that more than most people I've talked to over the last few years. And it's like, whoever you are, talk to Scott first. Scott will then identify what products you can take advantage of given your specific situation. And again, in some cases, he'll have me run numbers and say, no, Angel, it's not accomplishing what we want. We're going to go this way. Great. Doesn't cost you a dime. So,
Well, and the great question just came in. And this is something that you and I have talked a bit about. So I'm seeing your screen changed over to.
I did. Did you want me to bring it back up?
No, go ahead and just stop your share.
Okay.
So I'm still a bit unsure about the buyer's buy-in or support of this being an installment sale. Is it just like a typical purchase for the buyer? This is something that has come up because explain the different companies and their expectations in terms of disclosures.
Yeah, number one, we have to qualify the product, right? So we have to gather information, including from the buyer. Sometimes the buyer will say, hey, I've already entered into this agreement with the seller. I know you guys are trying to help this guy, but why do you need my tax information or, my social security number or whatnot? The annuity companies, they need to verify where this money's coming from, making sure it's okay. And then it's a matter of, talking to the seller initially, maybe before the sale, give them ideas as to what they might want to accomplish with the structured installment sales. So if and when the buyer shows up, it's like, hey, buyer, I'm willing to sell, but I need you to help. I'm going to need your assistance so I can take advantage of this product. And then the buyer may say, well, what am I looking at? What do I need to sign? And we can share that information as well. The lender, if you've got a buyer that has a mortgage, is applying for a mortgage and is paying, the insurance companies have nothing to do with that mortgage. There's no lien. That's another question again. There's no lien on the property. This is, at the end of the day, the final transaction is going to be between the seller and the life insurance company, and the life insurance company promises to make these payments to the seller as stated in the contract.
What I like about this is many people have sold their properties owner carry, and buyers have often fallen through on those owner carries. Now, I've known people that are hoping the buyers fall through because they take a big down payment and they're like, I'd like to keep doing that. Go ahead and fall through on me. But here it goes to the insurance company, and because these are A-rated insurance companies and higher, these are guaranteed. You have a lot of security there. So
there's a lot of security. Yeah, absolutely.
So to recap, you can sell a business with inventory and without real estate and use the Section 453.
Yep. Did we answer Hayden's question?
Yes.
Okay. Okay. There's another question. Recap. Can you sell a business with inventory and without real estate? So you can sell a business. Actually, I just had something up here that MetLife had put out. So some of the items that don't qualify might include the disposition of inventory. And that brings up another issue when you're looking at commercial, because many times there's two things going on there, right? Number one, you've got the seller of a business trying to sell their business, and maybe at the same time trying to sell their commercial property. Well, this product can help address both scenarios, right? So if you're selling a business that qualifies under Section 453, we can do the tax deferral. And in addition to, if they happen to be selling their commercial property, this can benefit them as well. Sometimes there's sometimes they'll find a way to deal with their commercial property, but say, hold on, because I'm still trying to sell my business and find ways to minimize my tax or whatnot. Well, this option can pretty much serve both. The best way to address, I think, a question like that is to just have us run a scenario. You talk to Scott. What I like again about Scott, he filters all the stuff. He sees all the moving parts, and he knows exactly when to reach out to me. And many times he comes to me with a summary. Angel, this is what we're looking at. What can you do? Great. He's already given me the information. I have my discussion with the insurance companies to see if I can get that qualified.
Thank you, Angel. And with that, so yes, as Angel was saying, this can work for business. You want to get on top of it. You want to talk to your tax professional. Many times that LOI is coming in and people are scrambling to figure out the tax strategy. So we need to get involved quickly, but with the business, we do need to get your tax professional involved. And here's the thing, you ask 5 tax professionals the same question, you're going to get 7 different answers. And so that's why we need to work closely with your tax professional, because they have various things, that tolerances that they have, what they're willing to risk, what they're not willing to risk, how they think, all of that. And that's because the IRS, you ask 5 IRS agents the same question around the country, you get 7 different answers. They don't always agree on some of these things. So that leaves the CPAs having to figure out what can make for a reasonable defense. So we have to get them involved. So if you've already gotten an LOI, yes, you can still do this. If you've gotten an offer on your real estate, yes, you can still do this. It just has to be done before closing. And
Yeah, and if a couple other comments, for as long as I've been settling claims, I'm dealing with families. We reach a settlement, and the questions are always, what do you want to do with the rest of your life? What are your issues? What are your concerns? What keeps you up at night? So we can tailor make these payments. Even though this product helps with taxes, I think it gives the seller an extended options, like what do you want to do? And I made some notes to myself. I mean, for example, again, older folks looking to downsize and move into an assisted living type facility for a primary residence. A lot of folks today don't even know that exists. There's an option. In my experience, I've had even realtors say, well, yeah, I sell real estate, but I own 5 pieces of real estate. Somebody else I met came by one of my booths and said, here's my daughter, but she doesn't want to take over my business and blah, blah, blah. And so I said, well, why don't you sell 1 or 2 of your properties, have this guaranteed income, pay it out for as many years as you want. So now your daughter will have guaranteed income as a beneficiary if you die prematurely. So now you've diversified your book of business. You've got your rental properties here. You've got guaranteed income on this side as well. I've had people, I think a lot of us go through it. I've got 2 adult children myself. One can handle money, one I'm not so sure. So it's not always a matter of like, I'm going to give you these assets and hope you can do well. These sellers are alive today. They can pull the trigger on certain things, and the seller can dictate what these guaranteed payments are going to look like. And rest assured that the payments are going to be there, right? And maybe child 1 won't blow it prematurely or whatever. Again, these are just scenarios that come up. Also for the seller, if they're older, now you've got guaranteed income, right? And in the settlements that I'm usually involved with, I've got guaranteed income. So now I'm paying monthly payments. I'm helping offset or cover the mortgage or the rent or the car bill or the groceries or the gas. Insurance premiums, some of these folks that might be a little older, hey, now you've got some guaranteed income. Maybe you should go get yourself a better, medical plan. Maybe you should get a Medicare Advantage, or if you have to pay more premium, now you've got, so it allows some of these folks some flexibility to do some of the stuff they haven't been able to do before.
So with that,
Yeah.
Angel, and we're going to wrap up here pretty quick. Can you take 2 minutes to also describe what a structured settlement is and where that comes into play?
Yeah.
Because that is your bread and butter for
my bread and
nearly
butter,
30
yeah.
years. And so people don't understand what that is. So if you could take just 2 minutes and explain
Sure.
what that is, because this is valuable information.
So, the annuities, very basic, right? An annuity or these payments, you put in a lump sum and the insurance company says, based on your age, amount of premium, we can generate these guaranteed payments over time. For almost 30 years, I've been dealing with physical injury, wrongful death claims. I help 2 annuity companies set up their structure programs. And what we do is, plaintiff and defense, the attorneys litigate, we're the numbers person. And so if somebody sues, wants $1 million, insurance company wants to pay 400,000, I get involved, they call me, and I'll say, hey, insurance company, if you give me 500,000, I can generate 800,000 or whatever, right? Guaranteed, no management fees. And for physical injury claims, the annuity payments are 100% tax-free. This product doesn't exist. The general public does not have access to this product. It's only physical injury, wrongful death, but like everything else, have to get involved before the settlement proceeds are dispersed, because even in that scenario, if they got a lump sum, the lump sum would be tax-free. But if they called me the next day and said, hey, I want that tax-free growth annuity, I can't do it because there's constructive receipt. So that's what we've done. So I have clients nationwide and in Puerto Rico. We do some pretty simple workers' comp claims, and we do ugly physical injury, people falling off roofs, horrific car accidents, and things of that nature. I love my job because it's a matter of taking whatever monies are offered and giving these folks an option, right? It's not mandatory, but let's have them make an informed decision before they say, I'm not interested, because if you call me the day after, there's nothing I can do. So this industry's been around a little over 40 years. Again, today there's only about 10 annuity companies that operate in this space. And so it's litigation heavy, but the structured installment sale that's only available to our broker channel is an extension. Now I can deal with the general public and say, hey, there's this other product that's available.
Awesome. Thank you for sharing that. And typically, what is the minimum case that you look at for the structured?
If some people would be surprised, quite frankly, it's about $15,000. And you think, well, who in their right mind would want to annuitize 15,000? I do a lot of minors comp cases. Your kid went to the neighbor's house and he got bit by the dog, or simple little things like that, right? And most judges will encourage the attorneys, if you take that $15,000 and put it in a bank and earn 0.01%, that's technically taxable interest. If you took that $15,000, put it into a structured settlement with that payment being issued in a lump sum or college fund starting at the age of 18, it's going to grow exponentially. And when it's payable 100% tax-free. So even judges will tell the attorneys, if they already haven't spoken to somebody like myself, go talk to the structure guy. Let me see the quotes before I, the judge, determine where I think these monies should go. So really, minimum's 15,000. The average is probably going to be about 300,000, and in liability and the medical malpractice we do, you're in the low millions there.
Okay. Well, thank you for sharing that. With that being said, thank you so much, Angel. This was a great presentation, covered a whole lot. Thank you, everyone, for joining. And I will be later today, I'll be sending out an email with some information. So please look for that. If you don't see it, check your spam folder, because I have 47,000 people in my database at this point. So if I send a hello email, there's a good chance just saying hello could end up in spam. So I hope everybody has a great rest of your day. Thank you for joining.
Thank you, everyone. Scott, as always, thank you, everyone. Thank you for your time. Bye now.
I hope this information was helpful. As a real estate agent, my mission is to help those selling homes and investment properties keep more money in their pockets. If you want to have a conversation with Angel Viera, he can be reached at 323-394-6609 or aviera@teamarcadia.com. Have a great day.